Hi, my name's Scott Dahl. Thank you for tuning into another one of my podcasts. Today is March 12th, trading in the morning. We're trading down again. For the year, the Standard & Poor's 500 is down 2.2% or very, very close to that number. The Dow is down 2.7%, and the NASDAQ is down 4%. If we look at it from the highs, the Standard & Poor's 500 is down 4% off its high. The NASDAQ composite is down 7%. And the Dow Jones Industrial Average is down 7% from its highs. Now, this is not uncommon. We typically have about 2 to 3, 5% sell-offs in the stock market per year. The average intra-year drawdown is 13 to 14%. So what that means is even in a positive year, the market typically falls double digits at some point before recovering. So the question is this a correction or is this a start of more of a significant bear market? Well, the fact that stagflation is priced in, stagflation is a horrible economic phenomenon. It's extremely rare that it happens. But if these oil prices remain elevated for a long period of time, yes, anything's a possibility. I'm not an economist, but I will tell you that stagflation, what it is, basically, the explanation is it's typically high oil prices, which creates rampant inflation. It's significantly more expensive to produce goods, and there's a lot of job layoffs, so there's a lot of unemployment. So if you have high inflation, expensive goods, and high unemployment, nobody can buy the goods. So it's this economic slowdown. It's kind of this economic rut that's hard to dig yourself out of, and that's why back in the 70s and 80s, the Federal Reserve raised interest rates so high that it choked off the economy and created a significant recession. That was the only way they saw from an economic standpoint to reset things. Now, I do believe, and if you go back to my podcast, Secular Market, Cyclical Market, it was about 2 years ago. What it does is it explains what I believe and why I believe it. I believe that we're in a long-term secular bear market. This is a bear market punctuated by high inflation, high interest rates. I will tell you why, looking at the charts and looking at price, that it's now time for that. The last one we had was 1966 to 82. The good news is, and what I think we're experiencing right now, is the market will move in bull and bear cyclical, shorter-term cycles inside this longer-term secular trend. So I think we're going to go sideways for a long period of time. However, you can make money because you'll have these up moves, these 3 to 4 year possibly up moves, and then these significant sell-offs. So you have to be nimble, but you can make money on these shorter-term bull markets. Now, what we're experiencing right now is actually, it could be good if you can pick stocks. And the market has been driven by the top 10 stocks. And let me be specific. The Standard & Poor's 500 is what's called a market-weighted index. The largest companies represent the largest percentage of the return of the Standard & Poor's 500. The top 10 stocks have represented close to 40% of the return of the Standard & Poor's 500 for several years now. Well, that's changing. These top stocks not really doing that well. They're down about 7% on average, and that's striking down the Standard & Poor's 500. It's also putting weight on the other indices as well. So I think it's a possibility that the indices, the Standard & Poor's 500, the Dow, the NASDAQ, they may not do that well this year, but because these top 10 stocks are losing their dominance, the other stocks are starting to come in and they're starting to do relatively well. So what this is this is a classic stock picker's market. What that means is if you find these stocks that have good momentum, that are actually starting to turn around positive and lead the market, then if you can focus money over into these stocks, you should have a significant possibility of outperforming the indices. So this could be a good investment year. I just don't know that by buying and holding the investments that represent the indices, I don't know if that's going to really work. It's yet to be seen, but that's what I think is shaping up. So the average drawdown, intra-year drawdown is 13 to 14%. We're down 4% of the Standard & Poor's 500. We're down 7% in the NASDAQ. From the top, on all three of these, we're down 7% of the Dow Jones. So we're down from the top somewhere between 4 to 7%. We can go down 13 to 14%, still consider this a correction. Again, what a correction is a correction flushes the speculative excess out of the market, allows new money to come in and drive the market higher. These are a normal part of the market process. These Middle Eastern conflicts, I've been through several of them. I remember Desert Storm, the market dropped before the crisis, and then it had this significant rally out of it. That was back in 1991. I've gone back through I think there's been 12 to 13 of these since World War II. And what's happened is we've had this downdraft, this shock, and then the market has recovered significantly. So these have a tendency to not create any long-lasting situation. However, I will say that if price of oil stays up for an extended period of time, then that would certainly be a concern for the market. So it looks like to me that what we're in now is we're in a correction until price, which, remember, price action alone dictates really what I believe is going to happen. It helps me stay away from the day-to-day noise or the news. Remember, the news is always the worst at the bottom of this. So the question is, this is a correction. I believe that we are experiencing a correction. So now what I'd like to do is just look at a couple charts, and we'll see where we're at on a price perspective. So the first chart I'm going to show you is the Standard & Poor's 500. It's in a short-term downtrend. It went sideways for about the entire year, the majority of the entire year. It's now broken down through the bottom. That means that it is definitely in a downtrend. We should find support down here at this 200-day moving average. It could go down further. It depends on what happens. It's a tenuous situation, obviously, in the Middle East, but it looks like to me at this point that we're still experiencing a correction. We could drop down 13, 14, 15%, and that would be a normal phenomenon for an ongoing bull market. Here's the Dow Jones Industrial Average. This is a little different story. Dow Jones went down to its 200-day moving average. Remember, these moving averages act as significant support. You can see that by the stops. Here's a stop at the 50-day moving average. Here is a stop at the 200-day moving average. Market went up. This is the Dow. The Dow went up. It tried to get through this trend line. It didn't happen. This trend line. So we're in a downtrend in the Dow. We've broken the major trend line. We are testing the 200-day moving average. This could certainly go down further. It looks heavy, it looks weighty, but still, at this point, would be considered a correction. This is a chart of the Dow Jones Transportation Average. The Dow Jones transports, they move the goods the Dow Jones Industrial Average companies make. This is a sign of healthy economic activity. We broke to new all-time highs. Here, about 2 months ago, we kind of plateaued and come right back down to this level of the breakout. So this level of the breakout should act as good support in the Dow Jones Transportation Average. Again, back to the Dow Jones Industrial Average. We're in the support area here. This is more than likely, a correction in an ongoing cyclical, remember, shorter-term bull market. Until this proves otherwise, I'd say that this is a correction. Let's look at one more chart. Remember, I'm big on breadth. You have to have a lot of stocks participate in order for this market to move higher. Well, breadth has been waning significantly, and it's pretty much the same story as the indices. If you look at this chart, this isn't a price chart. This is a chart of the stocks that are going up minus the stocks that are going down for every given day. And you can see the breadth has contracted significantly. Where are we at? We're right down on this, testing this breakout of when we broke out to new all-time highs for this. So what's happening? Price is going down, breadth is going down, the less and less stocks are participating. Everything's down in the support area where it's tenuous, but it still looks like a correction to me. What I'll do is I'll come back up with another podcast if the situation develops. However, we have a tendency, again, to resolve these Middle Eastern conflicts and just go ahead and continue higher. I don't see anything economically that's changed. We've still got the AI in play. That has driven this market because of the belief that we're going to have increased productivity. That's it. Call me if you have any questions. It's 949-497-6366, dahlcapitaladvisors.com. You can email me at scott@dahlcapitaladvisors.com. Please feel free to share this. It's Dahl Capital Insights. Thank you. I'll be talking to you again soon when I see changes or development that I believe needs to be discussed. And you have a wonderful day, and thank you for tuning in.